Hello traders, it's ETM Effects, and in this lesson, we're going to cover my go-to trading setup step by step. So when teaching a trading setup, what I wanted to do different is give exact specific rules, check every single criteria, unlike other channels that mainly focus on teaching in a gray area to avoid accountability and adding mystique. So what we're going to do here is go through every single criteria needed for this setup. And to solidify everything, I have 2 years worth of data trading this specific setup. So first of all, let's cover the technical aspect of this trading setup. So first thing is, it's basically your regular purge. But here are the rules to this purge. And we're going to cover the time and price theory and when to trade it at what specific time in a little bit. But let's focus on the technical aspect. First of all, your purge needs to be present on your 1 minute, 5 minute, and 15 minutes. But what I mean is you need to have a body close going through your stop hunt. So when price stop hunted, you want to see a candle on the 1 minute, 5 minute, and the 15 minute. So basically, sometimes you see a candle, sometimes you see a candle on the 1 minute. But when you go on the 5 minute and the 15 minutes, all you see is a wick. That would make this trading setup invalid. We also need one level of liquidity taken, and I'm going to explain this in a little bit. One level of liquidity taken. The amount of time spent outside of the range should be less than 5 minutes. This is extremely important. I would want an aggressive delivery heading to my entry. So I would want an aggressive price moving towards my entry in a rush. And I would want to see a clear inefficiency. So if it's a demand order block, I would want to see a clear demand order block, preferably untouched. If it's a gap, I would want to see a clear gap. And these are all the rules. Again, you cannot use this entry by missing one of the rules. So let's say your stop hunt here is available on the 1 minute, but when you go on a 5 minute, it's a wick, but all these other rules check out. This entry is still nullified. So here are the technical rules. We need one level of liquidity taken. Our stop hunt must be present in the 1, 5, and the 15-minute time frame. And of course, if it's available, if it's present on your 15-minute time frame, it will for sure be present on your 1 minute time frame. Just common sense. You would need an aggressive delivery towards your point of interest, a clear inefficiency, and the time spent above the range should be less than 5 minutes. And these are all the rules. You cannot miss one. Once you miss one, the probability of the setup goes down. So let's talk about the timing for this setup. For FX, in London session, you would trade between 2:30 to 4:30. In NY session, you would trade from 7:30 to 9:30, and you could even trade a little bit later in New York session from 10 to 12. For NAS 100 and SPX or any other indices like US 30, you'd want to trade the London session from 2:30 to 4:30, and you want to trade the New York session from 8:30 to 9:30. Then give it a break when New York Stock Exchange opens, and then you can carry on again from 10 to 4. So let's go over this example real quick. So here we have a stop hunt that's present on the 1 minute, the 5 minute, and the 15. And remember, this is the 5 minute chart. One level of liquidity has been taken. You have a clear inefficiency, which is your fair value gap, and price did break structure. So again, so far, you can see all the criteria has met. You have a clear inefficiency. You have a stop hunt that's available on our 3 time frames, and one level of liquidity has been taken. So what do we have here? Price came, reacted from this level, and this is where the extra steps came in. So we had an aggressive delivery. As you can see, it was a wick. If it wicked on the 5 minute, that means it was a very fast drop on the 1 minute down to our inefficiency. So we had our aggressive delivery. How long did price spend above the range before attacking our point of interest? Less than 5 minutes. Why is it less than 5 minutes? Because this is a 5 minute candle and price never closed above. That means it would wick out for 1 minute or 2 minutes and come back and close inside of the range. So the time price spent above our range is less than 5 minutes. So we talked about what would make the setup work. So now let's talk about what would make the setup not work. One of the main things is the time spent above the range. If the time spent above the range is greater than 5 minutes, the trade will more than likely not work. And if it does work, it would work at a very low probability in a majority of time. So as you can see in this instant, price consolidated above our range. That means it spent a significant amount of time above our range. So when price does come back, a lot of times this point of interest would not hold. Again, you would want the time spent above the range to be less than 5 minutes. It could come back, it can come outside of the range for 1 minute, come back in, come back out, and come back in as long as it's coming in. But if it's staying above the range for longer than 5 minutes in total, then the trade would be nullified. So another factor that would hinder this setup from working is the amount of liquidity taken. So if price takes out 2 levels of liquidity, this point of interest would more than likely not hold. So again, you would want to see 1 level took. So let's say price came up here and then dropped. This would be a good setup. But the fact that price took out 2 levels of liquidity, a lot of times the setup would not work. So the last scenario that can ruin your trading setup. Say you have a purge here, price took out your 1 level and it's coming back into the range. So here you have your liquidity being taken, so you can take check this off your checklist. You have your stop hunt. You can check this off your checklist, and you have your inefficiency right here. So you can check all these things off your checklist. Now, what's our last step? Is our aggressive delivery. So let's say price doesn't aggressively drop down. So let's say price just doesn't quickly drop to your point of interest. Let's say it starts hovering around, coming down, up, consolidating a little bit. This will nullify your trade. This will more than likely result in a loss and your stop loss getting crushed. All right, so this will be the end of this video. Make sure you like, share, and subscribe, and comment what you guys want next. If you guys want a deeper lesson on this setup, let me know.